So Rick, we ended our last conversation talking about the risks to fixed income, and risk kind of fits sometimes with volatility. And so I know within our research team and research process, we don't equate the two as the same thing. Risk and volatility are very different.
Yeah.
However, we had a great question from one of our clients, and I'm going to read it because it was stated very well. And the question is, what is our philosophy towards managing risk in our equity portfolios, and how is this philosophy implemented?
Yeah, that is a great question. And I think there's always this tug of war between risk and volatility. And a quote that always stuck with me is from Howard Marks. And he defines and says, risk is, more things that can happen than will happen. And that quote really exemplifies how we think about risk as opposed to volatility. So volatility is mechanical, it's quantifiable,
Right.
but it's not risk. And distinguishing between the two helps us take advantage of managing risk because you can't manage, volatility. And I think, a good example of that is in this current environment that we've seen over the past, couple of months. We've seen investors who have been, incredibly fearful of what's been going on in the market. They look at the day-to-day headlines and they sell down, stocks indiscriminately. That's volatility. Risk, in our opinion, is how we do our due diligence on our stocks and understand, how we manage our weights in the portfolio. And we take advantage of the volatility by stepping in when risk is the lowest, but volatility is at its highest.
Right.
And there's a key difference. So we firmly believe that when volatility is peaking, the risk to our stocks is actually the lowest. And that's when we want to buy for our clients.
Well, thank you very much, Rick. So in summary, when volatility is the highest, risk is usually the lowest. And that's quite often when investors should be taking action.
Yes.
Thank you very much.
And I think, a way to really drive the point home is to bring in an example of this. So what I'd like to do now is introduce Edward Friedman, who runs, our Canadian equity strategy, to provide an example of this.
Excellent. Edward, could you give us a couple of examples of how we think about and approach risk and volatility within our Canadian equity portfolio?
Yes. One example of how we took advantage of the volatility in the market was when we bought BRP, or Bombardier Recreational Products. Now I understand that the name Bombardier may sound scary to some, but this company was the crown jewel of the Bombardier Corporation, and in 2003 they were forced to sell it. And today it is owned by Bain Capital and the Bombardier family, and it has absolutely nothing to do with the troubled Bombardier company we hear about in the news. BRP produces all-terrain vehicles, ski-doos, sea-doos, three-wheeler vehicles, and speedboats. We've been following this company for a very long time, but since this company is a very high-quality company, it has a very strong innovative drive and very strong positioning in the market, it was always quite expensive. Since the company has a unique shareholder structure, its debt is somewhat on the elevated side, and the products that the company produces are highly discretionary, we believe that the risk in initiating a position at over $60 was too high and did not give us enough margin of safety, so we refrained from the stock at these levels. However, during the crisis, the stock dropped to $20, and we bought all the way down from starting at $45, and the last purchase was around $25. The reason why we purchased the stock at these levels, despite the perception that we believe is wrong, that the risk is high in the stock, is its client base and its innovative drive. I just said that the products the company produces are highly discretionary, and the common wisdom will suggest that in an economic crisis, this is the first personal expense to be cut. However, many of the company's clients are outdoor enthusiasts, and they spend a lot of money on the company's products whenever they have some spare money. And we believe that with all the support that governments are providing their people, their clients will continue doing so. Second, the company made a very strong commitment to innovation, which is why it has such a strong market positioning alongside Polaris, its main competitor. So when you look at these two factors, we believed that initiating a position or buying into this between $45 and $20, the risk in it was significantly lower, and we took advantage of the high volatility and we bought the stock. Now that the stock is getting closer to 60, we actually started trimming it. And another example of a company that we believe the risk is high in it, and we no longer own it, is Bank of Montreal. You can see on the chart on the screen that BMO's volatility was substantially lower than that of BRP's. However, we believe that the risk in it is actually higher because of what we believe is weak loan loss reserves. I'm not going to go into too much details, but we believe that BMO set aside too few reserves against future loan losses, which means that if the economic crisis will be more severe than they expect, they will have to set aside much more funds in the future, which will hurt their financial strength, with all the implications that go along with it. Now you see, we are not the only ones concerned about it. The US Federal Reserve conducted a stress test on the US divisions of RBC, TD, and BMO, and they found that BMO will be the bank that will suffer the most in a severe economic crisis. So yes, BMO stock experienced substantially lower volatility than that of BRP's. However, we believe that it's pretty clear that the risk in it is actually higher, and that is why we sold it.
Edward, thank you very much. Those are very good, succinct examples of how we think about risk and volatility within our equity portfolios. I'm joined by Imran Usmani, and Imran works on our international equity portfolio. And Imran, can you give us an example of how we think about risk and volatility with regard to our international portfolio?
Absolutely, Kevin. So in the previous example, Edward discussed two companies from different industries in Canada to demonstrate the concepts of risk and volatility and also show how we manage risk. On the international side, I'll be discussing two companies from the same industry to demonstrate those concepts. Maersk, the largest container shipping company in the world, is a good example of how we think about and manage risk while investing in a sector that's been impacted previously by the US-China trade spat and more recently by the COVID-19 induced global trade demand slowdown. Maersk's management has done a great job of managing costs and capital expenditures through different parts of the cycle. The company also has a competitive advantage because of its scale. Its large size in terms of capacity gives it a cost advantage over its peers. In the first chart that you see on your screen now, we compare Maersk's profitability with that of the next largest publicly traded peer, COSCO Shipping from China. As you can see in the chart, Maersk has consistently generated higher EBITDA margins than COSCO Shipping over the last few years. COSCO also has a much higher debt profile than Maersk. In its latest reported financials, COSCO Shipping reported a net debt to EBITDA ratio of 5.9 times. That compares to a net debt to EBITDA ratio of 2 times for Maersk. What that means is, if current conditions were to persist, COSCO Shipping could face an insolvency risk, especially in the absence of a government bailout. If that scenario were to play out, COSCO Shipping equity holders face a risk of a permanent loss of capital. In the next chart, we compare Maersk and COSCO Shipping's year-to-date stock price performance until June 30th. As you can see, Maersk is down about 17% year-to-date, while COSCO Shipping is down greater than 30%. So Maersk's business quality and healthy balance sheet has allowed it to protect capital on the downside during this downturn. However, it's interesting to note that initially, the market treated Maersk and COSCO Shipping similarly and placed them in the same bucket, as can be seen by the stock price drops at the start of the pandemic. This is usually a time when we see opportunities in the market that we like to exploit. As you can see, the stock prices of both companies have been volatile. However, in our opinion, one company, COSCO Shipping, is riskier given its more levered balance sheets. This also provides a good example of how we think about managing risk and positioning at the portfolio level. If the global economy were to recover, it's possible that COSCO Shipping's stock price could outperform Maersk initially. However, in a scenario where if current conditions were to persist, we expect Maersk to not only survive, but also come out of the downturn much stronger as its competitors and peers struggle to stay afloat. So from a risk-reward perspective, Maersk meets our risk management guidelines within our investment process. And at the same time, if we enter a more normalized economic environment, we can see the stock doubling from current levels.
Excellent, Imran. Thank you very much. You provided some really good examples of how we use our research process to define risk, and in this case, you really highlighted how balance sheet strength is an important part of our process.
Thank you very much, Kevin.
Yeah.